Hello stock investors. Today I'm going to show you how to value a stock. And since we know that buying a stock is just like buying a part of a company, then we're going to be talking about how to value a company as well. My name is Grant Gelati. I'm from BTMA.blog. You can see my site right here, a little bit about me. Anyways, valuing a company is very important to investing, one of the most important things. If you don't value the company, then you don't know what you're buying. It would be like buying a house without getting an appraisal. You get the appraisal to figure out how much the house is worth. If you don't have that, it's just like taking a shot in the wind. It's the same thing with buying stocks. You want to figure out how much the company is worth, and then you can figure out how much the stock is worth or its value, and then you buy accordingly. So you want to buy at a bargain price below this value. Alright, so to start off with, I want to talk about an analogy. Let's talk about a cow. We consider maybe a cash cow. You've heard this before. So when you look at a cow, how would you value a cow? Well, you'll have three things, and it's the same thing with a company. You'll have terminal value, you'll have growth value, and you'll have expenses. The terminal value of the cow would be if you killed the cow now and you sold the meat, which would be the assets. That would be the terminal value. The terminal value of a company would be if you sold off all the inventory, the factory, everything that was material of the company, the physical belongings of the company, the tangible assets, and you sold those off, then that would be the terminal value of the company. We'll simplify. The growth value of the cow would be the milk and the cheese that it produces, and these would be the ongoing earnings for a company. So you're going to try and figure out how much milk and cheese this cow could produce and for how many more years, and this is going to help you determine the growth value of the cow. The same thing with the company. You're going to figure out for Coca-Cola, for example, how much Coca-Cola it could produce and for how long of a time, and what these earnings are going to be, these ongoing earnings. And this will give you an idea of its growth value over time. For expenses, with a cow, we would think about what are the expenses of a cow? Well, you have to feed the cow, so the feed would be one expense. You have to maybe hire workers to milk the cow. And then you have other things like buckets and the barn and things like that. So these would be the expenses and liabilities for owning a cow. Same thing with a business. You'll have expenses and you'll have liabilities. To simplify, liabilities are things that take money out of your pocket. So there we have terminal value, growth value, and expenses. These are the things that we'll need to determine the value of a company or a cow or any other business. The next thing I want to do is show you how we find these assets, earnings, and expenses and liabilities. So to do this, we find the balance sheet, the income statement, and also the cash flow statement. These are three of the most common financial statements that we use to determine the value of a company or a stock. So to do this, I'm going to go to morningstar.com. You can use Morningstar, you can use Yahoo Finance, Google Finance, or any of the other financial websites. So what I'm going to do here first is put in a ticker, and right now I've been looking up this company, Taro Pharmaceuticals. And if you look on here, you'll probably see a lot of information. Maybe some of it you're not sure what it means. I recommend that if there's any information that you don't understand what it means, for example, forward PE, so you can go to investopedia.com, and this is a good website for just giving you any information about any terms you don't understand. So we can just type in here forward PE, and it'll give you a definition. And the interesting thing about it, it also provides a little video to help you out. Some of these definitions are kind of abstract and difficult to understand, so the definition video really helps to simplify things, I find. So along with that, it'll have on the one side, it'll give you the example of what it is and the definition, and then this will be your video. So here it will tell you about P ratio and what it means. Okay, so you get the idea, and it tries to simplify the idea for you. So going back here, let's look at the financials. So we're looking for those financial statements. And here you'll see income statement, balance sheet, cash flow. Sometimes Morningstar updates the way their website looks, so they might change it around and then you'll have to find it in a different place. But basically, you'll probably go under financials and then you can find it. On the other websites, Yahoo Finance, it's probably the same kind of thing. So right now, let's just start with balance sheet. And the balance sheet is basically, it has two main categories. One is your assets, and the other one is your liabilities. So with the cow, we had talked about the assets being the meat. Assets could also be something in a company that they own, for example, the factory, the machinery in the company, inventory. And then liabilities could be things that break down or things that need repaired, things that lose value over time, things that cost the money, things that are also that you owe money on. So here you have things that you own or things that the company owns would be the assets, and things that the company owes would be the liabilities, just to simplify it. So when you look through the balance sheet, you're going to see all of this information: receivables, inventories, deferred income taxes. So this could be overwhelming, but I just want you to focus on assets. Here are the years: 2011, 2012, 13, 14, 15, 16, and you can see the total assets. You want to look to see if they are consistent and if they are going upward over the years. And here it does look like, yeah, Taro Pharmaceutical, the assets are increasing and pretty consistently over the years. That's a good sign. What you don't want to see is that the company's assets are decreasing or that they are not consistent. For example, if it's at 796 and then the next was 1107, and then if the next was 300 and the next was 2000 and the next was 300 again. So this wouldn't be consistent. So right now we look good with Taro Pharmaceuticals. Then we look at the liabilities, and again, you have all these terms here. Could be confusing, but just try to focus on the important one here, liabilities. And you want to see that the liabilities are consistent, and if possible, that the liabilities, because they're actually a negative thing, if they were decreasing. So here we could see there was a decrease, and then an increase, and then an increase, and then a decrease. They're staying somewhat consistent. This one is a little bit of an outlier, but you get the point. Okay, so then we have our total stockholders equity. Total stockholders equity. This would be the most important thing that you want to look at. Okay? And here, this is actually the assets. So let's go back up there. These are the total assets minus the total liabilities. And then you get your total stockholders equity. This is the most important thing. And then this is split up. This equity is split up amongst all the stocks. These numbers are in millions. So 567 million split up amongst all those stocks or shares, sorry, that the company has. And if you're a shareholder of one of those shares, then you would get a portion of that equity. And you'd get that equity through either a dividend, or you'd get that equity through them reinvesting in the company or some other way, the value of the company, the price increasing. So then we can see here that the total shareholders or stockholders equity is, again, we want this to be increasing, and you can see it is increasing, and it was consistently, somewhat consistently increasing by the same growth amount. Okay, so that's our balance sheet. So again, the most important things were the assets, the liabilities, and ultimately the most important thing was the total stockholders equity. If you only knew one thing from this, it would be that. Okay, next one, let's go to the income statement. Here we are at the income statement. You can see it's in the same format, 2011, 12, 13, 14, 15, 16. This TTM is trailing 12 months, so this is the past 12 months. So let's look at what is here. Again, you can see all kinds of items: revenue, cost of revenue, gross profit, research and development, operating income, net income, earnings per share. So when we go through this, there are some important things that we want to look at as well. Basically, on the income statement, the most important thing is income. And then, to break it down even more, net income. So this takes out all the expenses and everything and just leaves the actual profit or the net income. And then to break that down even more into a more, let's say, digestible number is earnings per share. So net income would be the actual income for the entire company. Let's say $183 million would be what Taro Pharmaceuticals made their net income in 2011 to 2012. So when they divide that into all of the shares, when they break this company up into all those individual shares, then they give an earnings per share. So all this earnings per share is the net income broken into or divided into the individual shares of the company. So if you own one share of Taro Pharmaceuticals, then out of that $183 million in net income that they made for that year, you earned $4.11. I hope that makes sense to you. We have basic here and diluted. Now, I'll get into this more later, but diluted is usually less than the basic. So I usually use the diluted number because it's a more conservative number. You can see here it's the same, but if there is a difference, it's usually the diluted is usually less. The basic just includes the basic stocks, but diluted includes more stocks. So it would, or more shares. So it would include preferred shares and all of the other securities that are based on this company. So preferred shares, options, things like that. it might be confusing to you, so you don't have to really worry about that right now. But as I said, try to focus on the diluted more than the basic. Okay. This EBITDA, this is earnings before interest, taxes, um, depreciation, and amortization. So anyways, we're not going to really be concerned with that. It's not very important to us right now. We're going to look at the diluted earnings per share, also known as EPS. So we're going to be looking at, didn't want to highlight all those. So we're going to be looking at this right here, this row. Those will be the most important numbers. And again, we want to see that over the last 5 years that they are consistent and that they are increasing. So again, here you can see Taro Pharmaceutical looks good. It's increasing, and it's increasing somewhat in a consistent manner, but maybe here at the beginning it looks like it was growing more, and then in this last year maybe growing a little bit less, but not too big of a deal. It is increasing, and you can see it's going upward in movement, which we like to see. All right, so that is the income statement. Lastly, I want to mention that the income statement helps us determine if the company is generating income and if we believe that it will continue to generate income in the future. Moving on, we'll go to the cash flow statement. So the cash flow statement, it tells us about the exchange of cash within the business, mostly to pay off debt, and it helps us to determine if the company is able to pay off its debt. So here it's in the same order with the years. And then if we move down through, again, so many different items listed. We talk about cash flow from operation, the net income is in here. So this ties together with the income statement. You have non-cash items here, inventory here, accounts receivable, net cash provided by operating activities, net cash used for investing activities, net cash provided by used for financing activities. So many items, as I said. The most important thing here is we're going to look at the free cash flow. So the free cash flow can take a lot of these items into account, and we end up with this item. We're looking for the same thing here for free cash flow. This would be a good thing, and we want to see that this number is increasing and increasing consistently. And again, we see that Taro Pharmaceutical is doing a good job with this. However, in the last year, it did go down a little bit, but it's nothing significant to worry about. Just have to keep an eye on that, and if it does continue to decrease over the next few years, then that would be something to worry about. Okay, so that is the cash flow statement, and just from looking at these three statements, the income statement, the balance sheet, and the cash flow statement, I would say that Taro Pharmaceutical looks pretty good so far. The numbers have been increasing, and they have been pretty consistent for all the sheets. So these three sheets, these financial statements, give us the foundation of what we need to find the strength and health of the company, and also to start to find out the assets of the company, the liabilities, and also the possible growth of the company, see how well the income is coming in and being generated, and whether it could do that, sustain that for years to come. So that'll help us with what we talked about at the beginning, finding the terminal value, the growth value, and the expenses. Now, I just want to let you know that what I'm doing right now is just showing you a manual way to look at these items. And this could be overwhelming for you, but it's kind of good just that you get this basis versus foundation. And there is light at the end of the tunnel. There's a much faster way to do this, and we can automate a lot of this and make it more concise and remove this chance of human error by automating this analysis later on. Okay, so to summarize, we talked about the income statement, the balance sheet, and the cash flow. In the income statement, we talked about the most important thing would probably be the EPS and looking at the diluted number, the balance sheet, and looking at the equity, the total equity, and then the free cash flow would be the most important thing in the cash flow statement. These financial statements are good to do fundamental analysis on individual companies, but they're not very good at comparing one company to another company. So if you say that this company has $506 million in revenue, as we see here in 2011, we couldn't really compare that to another company. Let's say another pharmaceutical company. We couldn't really compare it to that and say that this other company has only made $100 million in revenue, because it all depends on the size of the company and their cost, expenses, liabilities, different things like that as well. So a better way to compare companies is to use ratios. So that's the next thing that we're going to look at, are the ratios. Moving on to the next section, we're talking about key ratios. And if you go up into your financial website, you should see something called key ratios, or it might just say ratios. So here we have ratios broken up into the years. You can see along here. And the ratios are good for comparing one company to another. It gives us a more comparable number that you can compare any company versus another company in a more apples to apples comparison. So I'm just going to go through and tell you some important ratios to look at. We'll start here, gross margin percent. So you can see here the gross margin percent. And again, with these numbers, like we did with the income statement and the cash flow statement, we want to look for numbers that are increasing and consistent. And so as we go along here, we could see that Tera Pharmaceutical, this company that I'm evaluating right now, it is increasing overall, and seems pretty consistent with its increases in gross margin percent. For gross margin, we're looking, or gross profit margin, we're looking at something around 30% and more, so this qualifies. For the next one, let's go down here. Okay, we could see more down here, profitability. Again, here's the gross margin. Return on equity. This is a big one here. This is one of Warren Buffett's favorite ratios. And so return on equity, in general, companies' standard is usually around 12%. And what we want to look for, what Buffett looks for, is something above 15%. So right off the bat, we can see in 2006 that Tera Pharmaceuticals had a terrible return on equity at minus 57. But then, as you can see, it quickly increased, and after that it had been consistently above 15, so that's good. It's better if it is increasing, but that wasn't the case here. Some of the years it's decreasing, but overall it is over 15, so that's a good sign. And some years it is significantly above 15. Okay. Return on invested capital is another one. So return on invested capital, we're going to be trying to look for something that is, again, above 15. And that first year, as we said, that was a terrible year. And then looks like most of these are above 15, with the exception of 2008 was at 8.61. And you also have to consider what was happening at the time, because you might find that most companies, they had a bad return on equity or a bad return on invested capital, or just a bad year overall around 2008, 2009, when we had the economic crisis happening. So you have to take those things into consideration too. Also, some industries in particular, they have bad profit margins, or their return on equity might be low overall in the industry. So you have to kind of compare it to the peers as well of that industry. Okay. Let's continue to look for some more. Here we have growth ratios, cash flow ratios, okay, financial health, looking at long-term debt. That could be a good thing to look at here, and you want to see that it has low long-term debt, or no long-term debt is even better. So you can see here that, or at least that the long-term debt is going down, and that's what has been happening here with Taro Pharmaceuticals, so that's a very good sign. And then here we can see that it has no long-term debt, so that is great. Current ratio is another one that's important to look at. And current ratio, this is basically a liquidity ratio. It takes the current assets divided by the current liabilities, and it tells us the stock's or the company's ability to pay off short-term debt. Warren Buffett generally looks for a current ratio above 1.5. So here at the beginning we could see that it wasn't above 1.5, but slowly it started to go up over 1.5 and has remained there, and it's significantly above 1.5 now. So that just basically tells us that it has more assets than liabilities. Therefore, if it needed to, it could sell off some of its assets, or it's holding enough cash as assets that it could pay off its liabilities or short-term debt. So that shows the financial health of the company and ability to liquidate. So that's current ratio. Let's find another one. Also here in financial health, we have debt equity ratio. So debt equity ratio, Buffett looks for something that is 0.5 or below 0.5, and we can see here that 1.82 at the beginning, here's 0.5 exactly, and then after that, after 2007, then it was under 0.5, which is a good sign. And then later on, 2015, we see that there was no debt because we had no long-term debt later on. Then we can see that there is no debt to equity. You want to see that it's lower for debt to equity, because basically, if you think about it, if you had $2 million in debt and only $1 million in equity, then this would be a higher number, which is bad. I mean, you'd have more debt than equity. So you actually want this to be a lower number because you want to have more equity than debt. All right, so that's a good sign for Taro Pharmaceuticals that it has no debt to equity later on, and then over here it was low as well, and that it was decreasing. So this is one of the other difficult things about doing manual analysis, because you have to kind of think these things through and which ones have to be lower or decreasing, which ones like current ratio have to be higher and increasing. So a computer, some kind of software, really helps to eliminate that inefficiency, waste of time. Yeah, actually, not waste of time, but you know what I mean. It just takes a longer time to do the things, and then you could mess up with human error. Okay, another one that we should look at is price earnings ratio, and that will be up in the valuation. Okay, so here we have price earnings. Buffett looks for price earnings in general of 15 or above 15, or sorry, below 15. See, human error. So basically, we're going to look for price earnings under 15 if possible. So again, it would be the price divided by the earnings, and you can see Taro Pharmaceuticals is 8.4, whereas the industry average is 56.3. So some people would say, wow, the industry is really overpriced here, because the price is very high compared to the earnings. Whereas Taro Pharmaceuticals has a very low price right now compared to what it earns. So we could say that this might be at a good price right now, a bargain price. You can see the S&P 500 even, Taro's even it's lower than the S&P 500 in general. And for Taro's 5-year average for the price earnings, it's actually much lower than that too. So in general, it does look like Taro Pharmaceutical is at a good price compared to its earnings in today's time. So this is something to look at, and it does say about valuation, but I want to note here that something that Warren Buffett said about price earnings ratio. So let me just find his quote here. So in 2000 annual report, Buffett said that common yardsticks such as dividend yield, the ratio of price to earnings, or to book value, and even growth rates have nothing to do with valuation, except to the extent they provide clues to the amount and timing of cash flows into and from the business. In other words, don't put too much focus on these indicators. So price earnings ratio, I know that many people look at that as like the holy grail of figuring out if a company is overvalued or undervalued. But in actuality, what Buffett is saying is you can't rely on this as determining the value of a company. It just kind of gives you a hint about the company and the cash flows, the amount and timing of the cash flows of the company. I've heard it described another way, as if trying to determine the value of a company through one indicator, such as price earnings ratio, would be like trying to figure out how much a person weighs just by looking at their shadow. So there are other things that you would need. You would need to know the time of day, the angle of the sun, um, maybe some other things about the person, or whether the ground was level that they were on. So you can see what I'm saying. There are other things that you need to know, other variables. And it's the same thing when you're analyzing stocks or companies. You can't just rely on one indicator. indicator or measurement. You need to know other things. You need to look at the fundamentals as well and put the puzzle pieces together to get an overall view of the company. Okay, then you can better determine or estimate value. All right, so that was price earnings ratio. And then another one that we're going to look at is PEG ratio. And this takes price earnings up here, price earnings ratio, and then it divides it by the growth. And it gives it a number. And with that, we're going to be wanting to look at something that is greater than 0 but less than 1. And I'll explain the units a little bit here. Typically, the PEG ratio, if it is over 1, it would hint that the company might be overvalued. If it equaled 1, then it would be at a fair value now. If it's less than 1, then it would be undervalued. However, if it's 0, which we see here, then it could say that there is 0 growth. Finally, if the PEG ratio was negative, then it would signify negative growth. So some of these numbers don't populate, and then you'd have to go look for it on a different website. So let's say, for example, that PEG ratio wasn't populating, and we'd have to go look at different websites, and I've opened these already. We just type in Taro PEG ratio, and then I opened the first 4 here. So when we go to NASDAQ, you can see that it didn't really give us anything for PEG ratio. Y charts did come up with PEG ratio. It's the trailing 12 months PEG ratio, and it listed at 8.641, which is not very good because we know it should be between 0 and 1. So this would be too high. It was good since about 2012 up to 2016. You can see the numbers were between 0 and 1, but then suddenly around June 2016 it shot up to around 12, and this is probably because the growth in the company decreased, so that would make the PEG ratio increase. Let's look at a different one here. So the Zacks didn't really give us anything for that, the PEG ratio. How about Guru Focus? So here PEG ratio is at 0.20, which is quite different from that 8.6, whatever that was, 8.6 on Y charts. So this is another issue with manual analysis. If you're jumping around the different sites to find these numbers, then they don't always use the same calculation methods or accounting methods. So it's better if you could get all your information and compare it in the same kind of way, which is not always possible if you're finding stuff and doing it the manual way. This could be eliminated later through using software or an analyzer, which I could show you later on. Okay, so let's go back to our valuation PEG ratio and even back further to our key ratios. And let's summarize what we talked about. So we had talked about how using ratios was a better way to compare one company to another one. The disadvantages of using ratios are that there are many different ratios, so this could be a little overwhelming. So you want to use a variety of ratios, and at the same time you want to focus on the most important ones, but don't focus on them too much As Buffett said, that, like, for example, the price earnings ratio, a lot of people focus too much on this ratio to get the value of the company, whereas he was saying that this just hints or gives us a clue to the value, um, or the timing of cash flows into and from the business. So it's not really, it doesn't really give us the exact value, but just kind of gives us a clue. So we want to look at a variety of indicators or ratios to get an overall picture of the company, and don't put too much weight on any one of them. So I hope that this has helped you to understand how to do fundamental analysis the manual way. This has given you a foundation to do that. The next thing I want to do is show you a quick and dirty way to value a company, or to find out if you can get it at a good price. So one way is, as we looked at before, to check out the price earnings ratio. So this is one quick thing that you can do to just give you a clue. So as I said before, the price earnings ratio, we're looking at 15 or less than 15. So here Taro is at 8.4, Taro Pharmaceuticals. The industry average is 56.3. So that's a good sign that it is undervalued right now. S&P 500 is at 19.6, so that's another good sign that it's undervalued. And the Taro 5-year average is at 12.5, and ours is right now at 8.4, so this is another good sign that it's undervalued. So that's one quick thing that you can do to look at a stock to see if it is undervalued right now, to give you a clue about that. Another thing you can do is go to Yahoo charts. So just go to finance.yahoo.com, or you can use Google Charts or Morningstar Charts, any of the charts that you can find. And I like to look at the 2-year chart. So you can see here with the price of the company, just get a feel for what the highs usually are. So we can see the highs are usually around this 150 mark, and then the lows, it bottoms out around this 129, 130 mark. And then the rest of these are kind of outliers. Now, it is extremely low right now for this 2-year span of time. So you can see right now would tell us that, yeah, it's pretty much at a bargain price right now for the past 2 years. You could also look here at the 52-week range, and you can see that the 52-week range is between 104 to 157. So we're at the 52-week low right now. So that's a good sign for getting a bargain. You can even go further, look at the 5-year, and also with the 5-year, I mean, it's good. The stock has been climbing, and then suddenly it took this drop for some reason. So you'd want to figure out what that reason is, why it took that drop. Maybe something happened that is significant. But if it's not something that is serious that's going to affect the company for the long term, then this might be an ideal time to get in on this company. As Warren Buffett says, you want to get in on a company when people are pessimistic about it, and when a good company is on the operating table. So that's not the exact quote, but it was something like that. You could look down here at what's been happening with the company to get an idea. You could look at news about the company. Don't get too caught up in headlines and stories. Just try to look at the facts of what's happening. So yeah, this looks like a fact here. Taro appointed a new chief financial officer. That could have affected things recently, but we could see that it started dropping back in August. So August 15th, so it wasn't just from 11 days ago. So you want to go back and figure out what was happening back then. The U.S. Justice Department subpoenas Taro over generic drug pricing, so this could be an issue as well. And things like that happen, lawsuits happen, but you have to see if it's going to affect the company for the long term. Okay, so that's another way to quickly see. So this was a good sign that maybe Taro is at a bargain. The next site we're going to look at is jita.com. So you can see it up here. And you put in your ticker. And I believe this one you have to sign up for, but it's free to get the basic information. On this chart, they have two lines. One is the Jita line, which is mostly, I believe, based on earnings, and they give you an estimate of the value of the company with this line. So you can see that they have it at around way up to 250, something like that. And then they have the Taro price line, so that's way down here at around 107.48. So there's a huge gap here between their somewhat estimated value and the actual price. So this would tell us that Taro is undervalued right now. So this could be a good sign of possibly considering to buy this company if it's at a bargain price. And they give you a score 8.45 out of 10 to tell you the strength of the company. So that one gives you an idea. I'll go to another one, which is Guru Focus. Okay, so we're here at Guru Focus, and right off the bat, you can see that this site has a lot of information. And if you're not sure what these terms are yet, then you can look them up on investopedia.com to get the definitions and figure that out. But basically, if you look here quickly and you see a lot of green, then you can figure out that that means that things are good overall. If you see a lot of red, then you could see that that could be a bad thing. Going down, you'll come to this chart at the bottom, which is the Peter Lynch chart. And the Peter Lynch chart has something called the Peter Lynch earnings line. So Peter Lynch earnings line is based on this idea that, similar to that Jita line, that the stock price should follow, it correlates with the earnings. And you can see that it has pretty much, in most cases, followed along. And all the way up here. There are exceptions, but overall you get the idea of it. And they have their value up at the Peter Lynch earnings line at 191.80. So that was quite different than the Jita line that was around 250 something. But you can see it still is showing that there's a gap here between the Jita line and the Peter Lynch earnings line and the actual price of the stock right now. So both of those tell us that the stock is probably undervalued right now or underpriced. So it could be a good time to buy the stock right now. So today we looked at the price earnings ratio. We looked at the Yahoo or 2-year stock chart to figure out if the stock was overpriced or underpriced. And we looked at jita.com, and we looked at gurufocus.com. So those four will give us a quick and dirty way to give us an idea of the value of the company and whether the price is overpriced or underpriced. I just want to warn that while this is a fast method to kind of quickly analyze stocks, it is not recommended that you just use these kinds of sites and then to make a decision on which stock to buy. This is not a thorough method in doing analysis, but it's just something to do as a preliminary method to give you an idea if the stock is undervalued or underpriced. Another thing about stock software and stock screeners, they're kind of limited. They're pretty good at doing their quantitative analysis, the calculating the numbers and things. They help to eliminate human error with that. They're more efficient than humans in most cases with calculating. But as far as qualitative analysis, they're not very good at doing that, and they can't really tell you the qualitative things like brand identity and economic goodwill, reputation of the company, the public perception of the company, future direction the company's going in, and your own investors' knowledge of the specific company. So those are qualitative things that the stock software, stock screeners can't really do or can't do well. Another thing with these types of quick and dirty analysis that we just looked at is that they are in most cases just analyzing one company at a time, and they just give a brief snapshot of a company at this moment. So they're mostly not basing their analysis or their estimates off long-term factual data. Oftentimes it's very short-term, especially with stock screeners. It's usually just at that moment what the P/E ratio is and the revenue and things like that. So it's just a quick snapshot or a first impression of the stock. And since you're only analyzing one stock at a time, the problem with that is that there are thousands and thousands of stocks traded on the US market. And so when you go through each stock analyzing it this way, by the time you get through all the stocks doing analysis on them, then you pretty much have to just start over again because those stocks have changed in price. Things that keep changing, and it doesn't give you a thorough picture of the company overall. They don't include important indicators. Sometimes they include too many. I'll show you an example here. If you look at this stock screener, I mean, look at all these indicators, and some of them we have talked about before about like return equity, debt equity. So some of these will be good to look at and important, and other ones might not be very important at all for you. So if you include all of these, that could be a problem as well because you're eliminating some good companies by including these indicators that are somewhat useless or ineffective for what you're looking for. So you want to have some of the good ones, but not include all of the other ones that you don't need, because that will limit the good companies that you can find. The other thing is that sometimes they don't include enough of the good indicators, so not enough variety. And some people put too much weight on one indicator or two. In addition, many of these stock softwares, analyzers, and stock screeners, they don't use diluted and normalized EPS values. They use basic values. The diluted and normalized are more realistic and conservative usually, so that would be a better value to use than the basic in most cases. Finally, when you're using any of this stock software or analyzers, you want to find out if it actually works. Is it proven? Does it have a track record, a winning record? So that would be a big concern for any software that you're using. So take all these things in consideration, and obviously manual analysis is tedious and inefficient, and a lot of times there's human error involved, so you can make a big mistake. The advantages of the analysis software, stock analyzers, stock screeners, are that it's faster, more efficient, less mistakes on the quantitative side, but the qualitative side is often missing, and we mentioned the other drawbacks to it. So I kept running into these problems myself when I was doing this, and so eventually I ended up building my own analyzer that incorporated qualitative and quantitative analysis together, and it accomplished many of the things that I was lacking with the other systems. So I'm going to go over to the BTMA stock spreadsheet and show you what that's like, and you can check it out for yourself. Okay, so now I'm going to take you to the Beat the Market Analyzer, the BTMA free stock spreadsheet. And here you can see the address, beatthemarketanalyzer.com/blog, and then there will be a link here for BTMA free stock spreadsheet, so you can try out this stock spreadsheet for yourself. And so let me quickly just talk about what this BTMA stock spreadsheet does and how it has eliminated some of the problems that I faced when I did manual analysis or analysis from jumping around to different websites and using some quick and dirty analysis methods. So this one, it can analyze up to thousands of companies at a time instead of analyzing just one company at a time like most of the analyzers out there. It compares every stock against each other and sorts them in order of the best stocks at the top and the riskiest stocks at the bottom, and I'll show you what I mean here. So this is an example of the information that it puts out, and it'll list the best stocks at the top here, good companies at bargain prices, and then at the bottom it'll list the riskiest stocks at the bottom. So these would be the riskier stocks. It gives a company rating score at the top. This is out of 100 points, and then going down the scores will get lower. The other thing what it does is it includes qualitative analysis, so not just quantitative analysis like most of stock analyzers. Instead of giving a snapshot of a company, it provides something more like a moving picture biography of the company because it uses 10 years of financial data. It measures for consistency and measures for upward movement of the different metrics that we were looking at before. Upward and consistent price, upward and consistent return on equity, upward and consistent earnings per share or EPS. So most of the analyzers don't do that. It tells us whether a company is able to overcome an economic downturn. So these are some of the categories. It looks at 10-year upward price per share. It gives us this convenient score at the top to look at. So if you're not very familiar with how to do analysis, just getting into it, if you're not a professional, I mean, this could take a long time to learn how to do analysis properly and to learn all the terms and understand them. And I've been doing this for years and I'm still learning things about analysis, and so it's not something that you could just automatically just absorb right away. It's a learning process, and still the numbers and values are so abstract that you have to kind of re-educate yourself over time. So anyways, if that's overwhelming to you, then this is a simple way to look at it. Very clear. So 10-year upward price per share, earnings per share, is it consistent and rising over the last 5 years? Ability to recover from a market crash or downturn. You don't usually see these in a lot of the analyzers. Return on equity score, return on invested capital score, gross profit margin score, PG ratio score. So it has all these. It gives you a total value score out of 100 points. It goes on, it gives you 52-week low and high, EPS over 10 years, so you can see each of the values and how it is, if it's consistent and going upward, but it already calculates that in the score for you, so you don't have to worry about calculating it. And it goes into other information about giving an estimated value of the stock, the difference that the 52-week low price is from the price at the start date that you had analyzed. Uses an intrinsic value formula, Benjamin Graham's, but it's been more conservative, and it has all these notes here. So if you have questions about anything, the notes are here for it, and it explains what it's about. I won't go into too much detail with this because you can download it for yourself and start trying it and read through it. and there's also a video tutorial on how to use it. Margin of safety price, so that you avoid overpaying for the stock. Any discount from the margin of safety price, so a bigger number is better. So it has a lot of things built in to help you buy a good company at a bargain price. It quickly recommends to you whether you should buy it or not. Sometimes it'll be green and it'll be a recommended buy. Other times you'll have these possible buys. Other times it'll say no. And then it gives you reasons why you should or shouldn't buy it. So it makes it very simple, and I've tried to eliminate and make it very concise so that for the newbie or anyone that wants to invest, that it's adequate for them, easy to understand. I'd also like to mention some of the other features here. So when you go to the analyzer and open it up, there'll be a disclaimer, and then you'll have a quick start, which will give you a tutorial on how to use it. There's a troubleshooting link that you can go to. There's a single analyzer, so you can quickly just type in tickers of any stocks and analyze them individually. And then you just click the calculate on button after you put in your tickers. Or you can use this multi-analyzer, where you could just paste hundreds or thousands of stocks here and then click the analyze multi-data button, and then it will analyze all of them. There are tickers provided for you. So S&P 500, Dow 30, Russell 2000, NASDAQ 100, and so on. So you can use those, just copy and paste them into here. Or you can go and paste any tickers that you find or you're interested in. If you find some list online that you'd like to paste in there, 52-week low stocks or biggest decliner stocks. Or if you use a stock screener and you find some and you want to paste them in there to find the cream of the crop, you can do that. Then afterwards, it'll put all of your analyzed stocks in this save data spreadsheet here. And it can even allow you to create an investment plan. So from the stocks that you have, you can make my investment plan, and it'll walk you through qualitative analysis. It'll ask you questions about the stock to help you find the specific stock that is best for you to buy. It even helps you to find out how many shares of a company that you should buy. So it offers a lot of unique features that I wanted for myself when I was building it that I couldn't find in other places, and it's based off of Benjamin Graham and Warren Buffett's value investing system. If you don't know Benjamin Graham, that's Warren Buffett's mentor. He's considered the father of value investing. So it's based off of that, and it uses most specific criteria that Warren Buffett uses in value investing. So I tried to pick the most important valuation methods for this. And best of all, it works. It has been back tested for 10 years, every month for 10 years, and it has beaten the S&P 500 over 85% of the time. So I really recommend this. I personally use it for my own stocks and investing. And I would like to say that, like all computers and software, it's not perfect. You shouldn't be totally hands-off with this. Once you do get a handful of companies that it recommends, then you should look further into these individual companies. And now is the time, after you get a handful, and eliminate all of these other stocks that you're not going to buy. Once you have a small list of companies, then it's easier to do a little manual analysis on these few ones to see which ones are the best ones for you to buy. Because ultimately, you're in control of your own money, and you want to make your own decisions that's best for you and your family on which stocks to buy. Now let me show you where you can get this. So as I said before, you can go to beatthemarketanalyzer.com/blog and just click on the BTMA free stock spreadsheet. You can get it there, or you can just use the full address here, BTMA free-stock-spreadsheet will be on the end of that web address. That's for the free one. That one is limited, so it only allows you to analyze 3 stocks at a time, but it'll give you a feel for using the analyzer. Then if you want to move on and get the paid full version, then you can go to just beatthemarketanalyzer.com, and it'll take you to the sales page, and you can get that here. It tells you historic results, so you can see how well the analyzer performed against the S&P 500. It shows you my personal results with portfolios that I own and how well I've done compared to the S&P 500. And here's another one of my portfolios. My return against the S&P 500, and I use my same Beat the Market Analyzer stock spreadsheet, the BTMA stock spreadsheet that you would be using. If you don't have Excel, or if you don't have a computer with Windows running, then you could try our BTMA Wealth Builders Club. So I'll explain that. So that is at beatthemarketanalyzer.com, BTMA Wealth Builders Club. So this is a service that we offer, and this service, it also includes information on there. This service is basically an inside look at my portfolio, and I do the analysis for you and the research for you. So this is good for those that don't have the computer that meets the requirements of the BTMA stock spreadsheet. If you don't have time to analyze stocks, or if you want a more personal mentoring and investing help service, or if you just want a second opinion and to have the research done for you, then you might like to try out the BTMA Wealth Builders Club. So in the Wealth Builders Club, you'll get daily recommendations of the most profitable, safest stocks to buy, along with thousands of analyzed stocks each week that I'll run through the BTMA stock spreadsheet and send to you. You'll get company analysis reports. Let me show you one of those. So I do analysis and research on the companies, and I provide this information for you. You get pros, cons, my verdict, overview, business fundamentals of the company, diversity, globalization, strength and growth, long-term debt. So you get a lot of information here done for you to make your decision easier on which companies to buy. Also, I give you my own prices to buy and sell stocks and a transparent view of my personal stock portfolio, so you can follow along if you want to. I give you the ability to follow my investing strategies step by step. I give you some tips along the way, answer questions anytime you have 24/7. Just shoot me a message and I'll help you out with customer service, and it's all personal and personal mentoring. So you'll save additional hours of manual analysis and research while having a huge advantage over other investors that are analyzing stocks one by one. You could try the Wealth Builders Club. There's a special trial price going on right now, so check that out. As I said, it's at beatthemarketanalyzer.com and then BTMA Wealth Builders Club. Okay, I hope you've enjoyed this information that I've provided for you about the BTMA stock spreadsheet, the free one and the paid one, and the BTMA Wealth Builders Club. Contact me if you like at grant@beatthemarketanalyzer.com. I'd be glad to answer any questions that you have, and happy investing.